Demographics expert Harry Dent says 2026 will be worse than 1929, stocks down 90%. But the 1% aren't hiding in bunkers, they're loading up on 4 specific assets. Let me show you. Welcome back to Wealth Architect, the podcast where we don't just talk about money, we blueprint your path to true independence. I'm Dr. Ben, your guide through the financial mazes that trap most people in the rat race. If you're new here, this isn't about pinching pennies or hoping for a lucky break in the stock market. We're dissecting the strategies the elite use to turn chaos into opportunity. Today, we're zeroing in on a prediction that's sending shockwaves through the corridors of power. Harry Dent, the renowned economist who's nailed market turns before, is calling for a cataclysmic event this year, 2026. A crash that could eclipse the Great Depression, wiping out 90% of stock values. But here's the twist. While the masses panic, the ultra-wealthy are positioning themselves to emerge stronger. They're not selling everything. They're strategically acquiring assets that thrive in turmoil. By the end of this episode, you'll know exactly what those assets are and how even you, with less than $10,000, can mirror their moves. Stick around. This could be the blueprint that safeguards your future. We'll break it down step by step. First, the demographic forces driving this cliff. Then, eerie echoes from history. Next, the precise assets the elite are accumulating. And finally, practical steps for you to follow suit. Along the way, I'll share real data, stories from past cycles, and insights to help you navigate what's coming. Dent's demographic cliff proof. Let's start by unpacking why Harry Dent is so convinced we're on the brink. It's all rooted in demographics, the raw data of human life cycles that drive economies. Dent's model isn't some crystal ball, it's based on predictable patterns in population trends. Think about it. Economies boom when large generations hit their peak spending years, roughly ages 46 to 50. That's when people buy homes, cars, invest heavily, fueling growth. The baby boomers did exactly that from the 1980s through the early 2000s, creating the longest bull market in history. But now, that wave is cresting. Boomers are retiring en masse, shifting from spending to saving, or worse, drawing down assets. Dent calls this the demographic cliff, a sharp drop-off in consumer activity that no amount of stimulus can fully offset. Look at the numbers. U.S. birth rates peaked in the 1960s, and now we're seeing the echo. Global fertility rates are plummeting. China's one-child policy aftermath is hitting hard. Europe's aging faster than ever. Dent points to his spending wave indicator, which tracks how these shifts correlate with GDP growth. When the wave turns down, markets follow. We've seen mini versions in Japan since the 1990s, stagnant growth, deflationary pressures, but this time it's global, amplified by 17 years of artificial stimulus from central banks. And the proof? Dent's track record. He predicted the 2008 housing bubble burst using similar demographics. Back then, it was the Gen X echo boom fading. Now, it's the big one. He sees early 2026, right now as we're speaking, as the tipping point. January's market signals could confirm it. A weak start often foreshadows a brutal year. If stocks dip sharply into summer, that's the precursor to the full meltdown. But why 90%? It's the bubble math. We've pumped trillions into the system since 2008, creating zombie companies and overvalued assets. When the demographic support vanishes, the house of cards collapses. Real estate, stocks, even crypto, all in a super bubble. Dent warns Bitcoin could drop to $30,000 or lower initially, but recover later. This isn't fear-mongering, it's data-driven foresight. Let me illustrate with a real-world example. Take Japan. Their demographic peak hit in the late 1980s, leading to the lost decade. Stock market down 80%, real estate values halved. Now multiply that by global scale. US, Europe, China all syncing up in decline. In the US, workforce growth is near zero, with millennials unable to match boomer spending power due to debt burdens and delayed life milestones. Digging further, consider immigration. While it props up populations, it's not enough.
U.S. net migration can't offset the boomer exodus from the workforce. In Europe, aging is even more acute. Italy's median age over 47, with shrinking youth cohorts. China faces a demographic time bomb with 300 million retirees by 2030, straining pensions and healthcare. Dent's models show these trends converging in 2026, with debt levels global at $300 trillion, exacerbating the fall. Even AI and tech innovations won't save us. They're productivity boosters, but without consumers, growth stalls. I'll share a story. In the 1990s, Dent warned of Japan's fate. Dismissed then, proven now. We're at the dismissal stage again. Historical crash parallels. To really grasp the magnitude, let's draw lines to history. Dent compares 2026 to 1929, not just in scale, but in setup. The Roaring '20s were fueled by a similar demographic surge, the post-World War I generation hitting prime earning years, plus easy credit and speculation. Stocks soared, real estate boomed, then, bam, the Great Depression. Stocks fell 89% from peak to trough. Parallels today? We've had our roaring era. Tech bubbles, housing surges, cryptomania, all on steroids from low interest rates and QE. Just like the 20s, inequality spiked, with the top 1% hoarding wealth. And demographics? The 1929 crash aligned with the Immigration Act of 1924, curbing population growth, mirroring today's aging populations. Take the 2008 crisis as a mini rehearsal. Subprime mortgages inflated a bubble, but underlying it was demographic weakness. Millennials weren't ready to buy homes yet. Result? 57% stock drop. Dent saw it coming. Now amplify that. No young generation large enough to fill the boomer void. Global debt at $300 trillion, far higher than pre-1929 levels. Even the Benner cycle, a 150-year-old chart tracking commodity and market cycles, points to 2026 as a peak sell-off year. History rhymes, and this time the verse could be devastating. But remember, crashes create fortunes for those prepared. Expanding on 1929, speculation was rampant, margin buying at 10% down, like today's leveraged ETFs. Banks intertwined with markets, no FDIC safety net. Today, AI hype mirrors 1920s radio and auto booms, game changers, but overvalued. Policy differences. Fed now has tools, but tariffs echo smooth Hawley, which worsened the 30s trade wars. Story time. In 1929, Joe Kennedy sold before the crash, sensing shoeshine boys giving tips, echoing today's retail frenzy in meme stocks. Inequality then? Top 1% held 24% wealth, now similar peaks, but safeguards like SEC exist now, potentially softening but not preventing the blow. Exact 4 assets the ultra-wealthy are quietly accumulating right now. So what are the 1% doing while the storm brews? They're not liquidating to cash under the mattress. No, they're pivoting to assets that historically preserve and grow wealth during downturns. Based on insights from insiders and patterns of high net worth moves, here are the 4 they're loading up on: gold, U.S. Treasury bonds, Bitcoin, and silver.
First, gold, the timeless hedge against inflation and uncertainty. Ultra-wealthy families like the Rothschilds have held it for centuries. In crashes, gold often rises as faith in paper assets wanes. Dent notes it holds up early in downturns, and with central banks buying record amounts, it's a no-brainer. They're not buying jewelry, physical bars, or ETFs like GLD. Why? Gold's scarcity, only 200,000 tons mined ever, and industrial uses in tech ensure demand. In 2008, gold rose 5%, while stocks fell 37%. Now, with geopolitical tensions, it's up 40% in 2025. Second, U.S. Treasury bonds. Dent's top pick for safety. Why? The government can print to repay, making them ultra-secure. Long-duration ones, like 10 to 30-year treasuries, yield gains as rates fall in recessions. Billionaires are piling into ETFs like TLT,
which could double in value during the crash. It's boring, but it works. Think how bonds soared in 2008 while stocks tanked. With yields at 4 to 5%, they offer income too. Wealthy use them for liquidity and tax advantages in portfolios. Third, Bitcoin. Yes, even in a crash prediction. The elite see it as digital gold, scarce and decentralized. Dent warns it'll drop initially to maybe $15,000, but smart money buys the dip, knowing it's the future of finance. Whales like Michael Saylor are accumulating now, betting on post-crash recovery. It's asymmetric, limited supply, 21 million cap, growing adoption in payments and reserves. Institutions hold 5% in BTC. ETFs like IBIT make it easy. In 2022's crypto winter, BTC fell 75%, but rebounded 150% by 2025. Fourth, silver. Often called poor man's gold, but the wealthy know its industrial demand in solar, EVs, and tech makes it explosive. It outperforms gold in recoveries, and with supply shortages, prices could surge. Elites stockpile physical silver, or SLV ETF, for diversification. Silver's dual role, 50% industrial, boosting it in green tech booms post-crash. In 2011, it hit $50 per ounce. Now at $30, upside potential is huge. These aren't gambles, they're calculated shields. The 1% use private equity firms and family offices to acquire quietly, avoiding market noise. Add examples. During 1929 to 1932, gold holders preserved wealth as dollars deflated. Today, ultra-rich shift from stocks to these, holding 20 to 30% in alternatives. How you can copy them under $10,000. Now the game changer, you don't need millions to play. With under $10,000, you can replicate this blueprint. Start small, scale smart. For gold, buy fractional ounces via apps like Vaulted or ETFs like GLD or IAU, lower fees at 2.5%. $1,000 gets you exposure without storage hassles. Use dealers like APEMX for coins, free shipping over $199. Risks? Price swings, but long-term hedge. Store in IRA for tax perks. Treasuries. Use treasurydirect.gov for direct bonds or TLT ETF through brokers like Vanguard. Allocate $3,000, low fees, instant liquidity. Buy laddered maturities for steady income. In downturns, prices rise as yields fall. Example, 2008, TLT up 34%. Bitcoin. Platforms like Coinbase or Kraken make it easy. Start with $2,000, buy on dips, use hardware wallets like Ledger for security. Remember, volatility is your friend long-term. Accept BTC for gold via some dealers. Dollar cost average to mitigate drops. Silver. Physical coins from dealers like Silver Gold Bull or SLV or SIVR ETFs. $1,500 entry, stack gradually. Fractional bars available. Industrial demand adds growth. Store securely or in vaults. Diversify, 25% each, rebalance quarterly. Avoid leverage, focus on preservation. Consult a fiduciary advisor, but act now before the cliff. This isn't advice, it's a starting point to architect your wealth. Add crypto apps for ease, like Bybit for metals-linked trades. We've blueprinted Harry Dent's dire warning, the demographic forces at play, historical echoes, the 4 assets the elite are grabbing, and your actionable steps to join them. In times like these, knowledge isn't just power, it's protection. If this resonated, hit subscribe, turn on notifications, and join our community of wealth architects in the comments. What's your first move against the crash? Share below. We're building together. Check the description for resources, and remember, the system works for those who design it. Let's engineer your freedom. See you in the next blueprint.